We're not risk takers when it comes to the money we've saved, and you see people who are still have kept their 401ks and they're losing money with the market the way it is. And you don't want to take that chance on losing it.
Last year, Tom and Kathy Izzo were faced with retiring during a downturn in the market.
Shortly after I retired, I think the Dow had gone up as high as 14,000, and I mean, I just knew that that couldn't continue that way. And of course, it wasn't long after that it started on its downward spiral.
To hedge against a bear market, the Izzos turned their 401k into an annuity that guarantees their principal remains intact.
I have an annuity that's called a fixed indexed annuity. Basically, you put a lump sum of money into this annuity and you pick an option of some investment option. I chose the S&P 500, but I guess it really wouldn't have made much difference in the past year what investment option I chose. I probably wouldn't have gained any money, but the good thing is I didn't lose any money either.
Dan White is a certified financial planner and retirement specialist in Glen Hills, Pennsylvania.
What this type of contract does is it allows people to tie their interest rate to one or more of the major stock market indexes. All of these products have certain caps and limitations as to the upside potential that one can sustain throughout the life of the contract. They also offer fixed accounts inside the same contract in the event of a bear market. Okay, so one can switch back and forth between the fixed account and an index type of an account as market situations change.
For retirees who are confronted by a bear market, White recommends focusing on the near future.
A lot of people say to me today they hope the market comes back. You know, they'll say it always does, and I agree with them. The problem is it going to come back in time to benefit them?
At the end of the day, the Izzos say they know they've been safe investors.
I mean, I know we could have done a lot better had we put more money into investments. I'm sure we could have done better, but we're certainly comfortable and we really can't complain.
For FoxBusiness.com, I'm Catherine Tuggle.
Mark in Ohio, you're on the money line. Talk to us, Mark.
Yes, Carmen. I invested $175,000 over the last 5 years into equity index annuities. The current value today is $225,000, and my friends are telling me I should take the penalty on those, put it in the market, which would be about $200,000 after penalties. Do you think that's a good idea to do in today's market?
Well, Mark, are they advising you this because everything's so cheap? Is that the reasoning?
Are they brokers?
Yeah. Market?
Well, listen.
Well, here's the thing. First of all, Ray, I want you to explain a little bit about the annuity product he has, because most folks with annuities, different types of annuities, would see a huge penalty that absolutely make no sense. He's saying his penalty is closer to 10%. I still don't think it makes sense.
It's a ludicrous penalty, first off. You shouldn't get out. Now, this is an equity indexed annuity. That means your principal is protected. You're going to get $225,000 out of this annuity. If you wait a few months, you don't pay the penalty. If you choose then to do a 1035 exchange or cash out and pay taxes, that's up to you. But to get out of an equity indexed annuity, which incidentally, the reason it's called an equity indexed annuity is because your interest that's credited on this policy is credited based on how well the index performs. So to get out of the market, to get into the market makes absolutely no sense.
I mean, Steve, think about it. I just don't feel like this penalty, taking it even now, it's going to grow over time.
There's a bigger point here. The point is that, Mark, that you are looking at product picking. You're looking at this product here, this timing there. You really need to sit down and work out a plan to figure out what it is you're trying to accomplish over time. What is this money for?
Yeah.
Mark, did I hear you say that you began 5 years ago with about $175,000 in this product and you have $225,000 now?
That is correct.
Boy, I wish in 5 years I had a product.
Pretty well,
I wish I had a product that had grown from 175 to 225 in the past 5 years.
But here's the thing, Mark. I mean, make that decision. You have a couple months to weigh your decision, but you really have to look at, like Steve said, like Ray said, what is this product you're in? Are you in the market? How are you in the market, Mark?
This is a 5.15. I figured it out.
That's right.
A 5.15% rate of return for the past 5 years. You should be patting yourself on the back and actually thanking the person that sold you the equity indexed annuity. Stick with it at least until May, and then talk as Steve said, to a financial advisor. It's a pretty good deal.
Well, investors once again putting money into equity mutual funds. But just as retail investors started to do that, fear hit and stocks have sold off. It's grim. So is there a way to make money and be safe too? Pete D'Arruda is founder of Capital Financial Advisor. He's part of our advisor network, and he joins us today. Pete, it's tough to be an individual investor. I mean, they finally start to put more money to work at the beginning of the year. And, perhaps you have a black swan event, whatever it is, yet again, a little guy is getting hurt. How do you avoid it?
Well, Aaron, it's what always happens, Murphy's Law. Well, when you least expect it is when things happen. But what I like to do with my clients, and especially those that are getting ready to retire, and with baby boomers retiring at a rapid rate now, what we're trying to do for them is get them some safe income. And we've found some pension income annuities that do this safely for them. And by doing that, by putting money in a pension income annuity, which gives them a stream of income they never have to worry about outliving, and also for their spouse too, that enables them to keep some money at risk and lets that risk account stabilize, which means they don't have to take money out of risk accounts to get income, which gives them the time they need to hopefully have the market recover. So the annuities do the heavy lifting, and they give you a guaranteed income, which in my opinion can replace bonds in many people's portfolios, give them that safety and guarantee they need, and also enable them to take more risk with the risk money because they already have their income account designed for them, where they don't have to worry anymore.
Out the quarter, it's worth knowing that $44.5 billion of muni bonds were issued in the first 3 months of this year. That's actually the lowest level since 2000. So many investors, of course, fear states and cities may default. One advisor says he has alternatives to readjust your portfolio. It's time for the Financial Advisor Network. Chris Abts is CEO of Cornerstone Retirement. Chris, people are worried. You can see that from the outflows from muni bonds. What is your central advice to them?
Well, there are concerns with muni bonds. Many people are concerned about maybe an increased default, but also muni bonds are just not earning that much in low-rate environments. And a recent study shows that 80% of retirees and pre-retirees are looking for solutions to generate that income without risk to their principal.
Sure. Can you give me a solution? Can you point me in the right direction? Briefly, if you would.
One thing we've been using with our clients is what's known as a sequential income plan, which is designed to generate that income using significantly fewer assets without risk to the principal. We break this out in legs, and the first leg would be something like a fixed annuity designed to generate that income for, let's say, the first 5 years. A different type of annuity might be used for the second leg to generate income for the next 5 to 8 years, and then maybe something like a fixed indexed annuity would be the third leg, something with a bonus or an income rider to generate that income for the rest of their life.
Tantalizing. Chris, we've got to leave it there. Thank you very much. Chris Abts at Cornerstone Retirement.